Thank you for Good afternoon, and thank you for joining us today. My name is Natalie Wolf, and I'm the Director of Investments at Foundation for the Carolinas. And on behalf of the executive leadership team at Foundation for the Carolinas, we thank you all for joining us today. If at any time during the webinar you have questions or like further clarification on a specific topic, we invite you to post your questions in the chat. The Mercer team will address these after the presentation during the Q&A portion of the webinar. If we do not get to your question during the session, we will follow up with you directly after the webinar. This webinar is being recorded and the link will be added to the fftc.org website. You can access this by going to menu and the link is under Engage, Events and Webinars. I will now introduce Travis Pruitt and Tim Westrich, who lead our consulting relationship at Mercer. Travis will be leading the discussion and will address market conditions and investment performance for FFTC's investment pools during the first quarter of 2023. And I'll hand it over to you, Travis.
Great. Thanks, Natalie. Hi, everyone. Thanks again for joining us. I hope all is well in your first 4 months of the year. We'll jump in and do some background stuff. I'll have Tim weigh in with his thoughts along the way as there are specific places for him to fill in. We'll cover all the performance, give you a sense of where we're going, and hopefully be able to field some questions. So, so far this calendar year, it's been pretty darned okay from a broad equity return environment. So, global equities in general across the world have been up. The Russell 3000 was up a little more than 7% in the first 3 months of the year. The EFA index, which is developed markets outside the US, up about 8.5%. And even emerging markets and smaller cap stocks, albeit up to a lesser extent, were up quite a bit in the first 3 months of the year. It was a pretty interesting market as it was narrower than average, or in some ways, reminds us of 2019, 2018, where the market leadership really narrowed into a top number of names. And I have a couple of stats on that in a few minutes, but we did see the popular indices really perform pretty well. Smaller cap stocks and EM stocks have showed less momentum in the last few months. And in fact, if we look back from the end of September, the best performing market actually in the world are the EFA indexes, led really by Europe. Coming into the end of September last year, Europe had a bit of a cloud over it, if you will, from the Russian incursion into Ukraine and the impact of the potential for higher gas prices, given the reliance on gas in the European market. And since the weather turned out much better than expected, and the war has really, if you will, been somewhat contained, the European markets were able to post better than expected growth, and as a result, we're able to post better than expected returns. So actually, through the last few days, since the end of September, the EFA markets are up nearly 30%, or about 30% over that 7-month period, where S&P stocks are up about 15%. So it's changed in leadership for sure that we have not seen in a while. I lost my circles. Okay, so we did see rates fall as well during the first quarter. So you can see the Bloomberg Aggregate Bond Index was up about 3%. We did see rates fall in the middle of March pretty significantly as the market digested the news of Silicon Valley Bank and the other two banks that hit the skids in that quarter and were actually taken over by the FDIC in the first quarter of the year. So we did see rates fall. Rates had been climbing in concert with expectations about Fed activity. Fed rate market, though, changed really pretty dramatically in a short period of time, and that helped bond returns for the quarterly period. We did just see the Fed raise for the 10th time in a row yesterday, 25 basis points, moves the overnight rate to 5 to 5.25. The Fed has signaled that they didn't say the word pause, but they're not providing any further forward guidance. So they're going to take each month as it goes. But our interpretation at this point is a bit of a pause, see how it goes, let the rate environment work its way through. It seems highly unlikely that rates will be cut by the end of the year. but I'll touch more on that in just a couple minutes. And then finally, at the bottom of the page, you can see some of our diverse assets. REITs had a bit of a bounce back after a tough year, but we did see the price of oil come under a fair amount of pressure, and it continues through today, where in addition to bond markets and perhaps some parts of the stock markets pricing in slowing growth and recession, the oil market certainly seems to be doing so. And we saw oil prices move to sort of cyclical lows over the last few days, and that's weighing on both the companies that do those as well as the direct commodities. And you can see that in the commodity number on the bottom line there on the left-hand side. Of course, the one-year period really still reflects two of the worst quarters in 2022. As you can see, most of the trailing one-year returns are still negative. To my earlier point about the EFA stocks, the developed market stocks performing much better over the trailing year. And cash rates actually, now that short rates are overnight rates and short end of the curve rates are pretty high, there actually is some return from short-term fixed income in the market today. Talked about those. So let's move into a little bit more style specificity. Yeah, boy, easy for me to say. So we did see the market rotate beginning in the fourth quarter, but really in earnest in the first quarter, away from the value-oriented stocks that had dominated much of the first 3 quarters of 2022 and back into those well-known, if you will, more stable or higher expected growth names, particularly in large cap stocks. So in our chart here, you can see the Russell 200 growth index. So this is the top 200, excuse me, the 200 largest names with more of a growth orientation. So think names like Microsoft, Apple, NVIDIA. Those stocks performed extraordinarily well in the quarter. And in fact, much of the returns that we saw across the marketplace, particularly in the top end of the most popular indices, were driven by just 7 names. Over the course of the quarter, 7 names, including names like Tesla, Amazon, Meta, Microsoft, Apple, they were up. They accounted for 78% of the Russell 1000 index return in the first 3 months of the year. And much of that, if not all of it, is really from PE multiple expansion. So it does signal that investors either were doing some bargain hunting or that they believe that a recession might be on the horizon and they're refocusing on companies that they believe can grow. So that's an interesting market characteristic that we're keeping an eye on and thinking about as we navigate through the rest of this year. Certainly, it just wasn't, as you can see by the red circles that we have here, it wasn't just in large cap where the outperformance was meaningful. It was in mid cap growth stocks and small cap growth stocks as well. So there was much greater interest in higher expectation or more speculative names. In fact, the most expensive stocks in the Russell 2500, so in our chart here down in the Russell 2000, outperformed the rest of the benchmark by 4 to 5 percentage points over the course of the quarter. So there was a meaningful change in risk appetite for investors in this first quarter period, and that's something for us to keep an eye on and digest and think about as we think about how the portfolios come together. And then over the last year, you can see there was enough of a move over the last quarter and a half that we're starting to see some change in leadership over the longer term periods. So those inflection points we think are important, and we're going to keep an eye on that. Just economically speaking, we talk about some of these charts over time. We start with this view on inflation because it has been an increasingly important characteristic over the last 18 months. After really having no inflation in the U.S. economy or really much of the global economy for the better part of 20 or 30, maybe even 40 years, depending on just how stringent you think about inflationary growth. But inflation certainly was a problem early in 2022, which is what led the interest rate environment to change. But as you can see in this chart on the left-hand side, this upper left-hand corner where the circle is, market expectations for inflation actually have come down and come in quite a bit. So these two lines are just two different ways to express what investors think future inflation will look like. And it's, both of the measures have settled into longer term rates between 2 and 2.5%. And so while not all the way down to the Fed's target rate of 2%, much closer than certainly the current year over years, or even some of the subcomponents might suggest inflation to be. So I think this is important to continue to watch. We continue to think about it in the context of interest rates. You know, if we think about interest rates on the upper right-hand side of the page, the yield curve continues to price in a recession. And so what this chart is, if you're unfamiliar, is just the term rate structure or the interest rates the market participants are currently requiring at a range of maturities that are defined across the bottom of the chart. And most of the time, the chart has a shape like the purple line, which was the prevailing rate environment at the end of 2021, that this curve is generally upward sloping to the right, suggesting that you're taking on some risk by investing in longer term bonds. And for that, you generally seek higher return as a result of that. When the curve gets upside down, as it is, or inverted as it is in the top two lines, then the market is suggesting that perhaps we could see a slowdown, and an economic environment and growth might not be nearly as strong as it had been. Eventually, these curves need to correct and go back to the upward sloping. What we're continuing to watch and think and talk about internally at Mercer is how will that happen and what will be the drivers of that. That's important to our overall. That's important to our overall portfolio positioning because we are underweight duration, if you will, in our long-term portfolios. We remain comfortable with that position because we're just not quite sure how this curve gets back to a more normal shape. And the pathway will have impacts on overall performance. So we think there's some risk to that. So we're continuing to hold that short-term duration in the portfolio. And then finally, you know, I've noted this a couple of times, but another way that the market seems to be pricing in recession is in their expectations for Fed activity. And so this bottom chart, this is the overnight. This is basically the market pricing in the probability of the rate environment for each of the periods defined at the bottom. And so by humping up a little and then pointing down to the right, it suggests that market participants believe the Fed is going to cut rates. This is before yesterday's action, so I'm interested to see where this pricing looks now. But the Fed seems, in our mind, to be pretty clear that they're not likely to cut rates. And in fact, we think the economic environment would have to be pretty bad and a long way from where we think we are today to see the Fed cut rates before the end of this year. And so this curve that you see with the downward sloping pink arrow, this is also something that we think will need to level out and at least flatten, if not marginally steepen, you know, through the end of the year. And so those changes in expectation, and you've heard me say this before, as the market realigns to these expectations, this will cause some volatility. It has caused volatility to the upside, fortunately, generally speaking, so far this year, at least for the bigger cap stocks and some of the growthier stocks. But we do think that it's going to lead to volatility throughout the year as investors have to pivot and change and react to the market data. And so, you know, it's still very difficult to say what the year return might look like. You know, we're off to a pretty good start. We could give that back. It's just very hard to say, but we do think, a client joked with me the other day because I said, I made this statement and they said, so it's going to go up and down, so you're covered. And that seems like a chicken way out, but yes, we're not sure the path of, or I suppose the end point that we'll get to at the end of the year, but we do think that we're going to continue to see a fair amount of volatility across multiple markets. So with that background, let's just touch on the building blocks that go into your portfolios and how the pieces come together. As you recall, these are multi-manager strategies that we own and manage on your behalf, and folks across the entire FFTC organization and ecosystem are investors in these various funds. It was when we have these types of market environments where returns are driven by a narrow number of names, it does become more difficult to perform from an active management perspective. And that's, in my 30-year career, I've seen that several times. And, you know, invariably, if it's just a small number of names, it is a little bit more difficult for active management to perform. So we did see in the first quarter that US equity and non-US equity on there in the upper top half of the table there did both underperform in the quarter. I think this is reasonable. This is reasonably in line with expectations. You don't like to underperform, but there are certain market environments when you think that that could happen, and that did end up being the case in our two largest allocations for the portfolio. We can see the emerging market strategy, which had a rough start for the first quarter of last year, given the Russian advance on Ukraine. That portfolio did take some greater than average losses, but between recovery of the managers and then some more changes we've made recently that we described last quarter, performance has been much, much better. You can see a small premium for the quarter or a pretty good premium for the quarter and a small premium for the trailing 1 year period. We do like where we are there. We did take out one of the active managers, the manager that had the overweight to Russia in October of this last year. They performed pretty well up to that point. And then today we have 3 managers plus core index position. Was pretty happy with the execution thus far, and performance to date has been good against the benchmark. We're continuing to review that structure and see if there's something else we want to do, but we're very happy with the 3 managers that we have today, and they continue to perform really pretty well. Global opportunities, similar story as the US equity, the narrowness in the marketplace. Global opportunities has a greater structural allocation to managers that are with small cap securities, and that contributed to underperformance. I know this has been a more challenging part of our portfolio for the diversified long-term growth model. The portfolio managers are re-underwriting the entire structure just to make sure we have the right pieces in place to perform going forward. And we are making a manager change and here in the coming months to one of the underlying small cap managers to sort of change the tenor of that portfolio. So still very much like what we're trying to achieve with this part of the portfolio, and it will be lumpy, and we have experienced that, but it's been a little bit more challenging as of late. When we look at the real assets at the bottom of the page, these have been by and large as a group have been a very strong diversifier for the portfolios over the last 2 years. These are owned in the longer term pools, basically of all flavors. The active manager, Lazard Global Listed Infrastructure, continues to do a nice job. This is a pretty concentrated portfolio, only about 30 names globally. They own big positions in organizations like railroads and utilities. They performed very well over the, really, when we first hired them on your behalf, they had about an 18-month period where they underperformed, and they've really performed strongly since that time. And you can see nice contributor for the quarter. The global REITs or real estate index, so these are publicly traded real estate investments, they participated more fully last year, given the change in interest rates, not only the general overall economic level, but of course, real estate tends to have a leverage component to it. And so as a result, we did see those stocks come down quite a bit. And there's some questions still about that part of the marketplace, but we do like a small allocation to that dedicated over the long term. And the natural resources, as I mentioned in my commodity comments, the price of oil has come down quite a bit. And another, if you will, signal from the marketplace or symptom of the marketplace pricing in expectations for slower global growth. I'm not an oil expert and I don't trade oil. It feels like it's a lot. So it would be interesting to watch that marketplace develop over the next several months as we see global actors change, and the China growth rate is quite important to that mix as well. So it'll be interesting to see, but you can see a little bit of underperformance, or excuse me, a little bit of negative return in the first quarter in what it was otherwise a pretty positive environment for riskier assets. Finally, for the lower risk or risk reducing portions of the portfolio, for those of you in the diversified long-term growth, you'll recall that we do use our absolute return hedge fund portfolio as a companion piece to core fixed income. Pretty solid absolute return and relative return for the quarter for the strategy. Relative to bonds, just a little bit behind, as I mentioned, rates move pretty quickly, but that 1 year value of owning that diversifying piece really apparent with the year-over-year comparisons between the hedge fund allocation and core fixed income. With the core fixed income strategy, strong performance out of core fixed income for the quarter. While we saw rates come down, we saw spreads add value. And so there was a bit of a bias to corporate, which is what we have in this portfolio. We think that's still the right long-term positioning. And as a result, it added value here in the first quarter. A little bit of weakness in the bits of last year, but over the life of the portfolio itself, it's performed really pretty good versus benchmark, and we continue to like it. The low duration strategy underperformed just a little bit in the quarter and a little bit over the last year. No concerns whatsoever with the manager. As I mentioned, we do own the sterling allocation at about 20% of our fixed income in our longer term pools. That has generally been additive, although in this quarter it would have been a modest detractor versus our core benchmark. But we think the risk reward profile looks pretty good still. There is, as I mentioned, as we believe the rate curve has to correct and get back to that upward sloping state, and the pathway to that is unknown, and as a result, that creates some risk. And we think holding a small amount of lower duration fixed income continues to fit nicely in the overall risk reward objectives for those portfolios. So rolling right along, we'll touch base on your options for the portfolios for the quarter. As might be expected, with a more challenging active environment for our component pieces or our building blocks, is that did translate into some modest underperformance versus our policy indexes for the quarter. Again, I think these are well within expectations given the market environment and our portfolio design. Fortunately, not too terribly out of whack in most of those places. It gives us room to outperform. The one place in the quarter where there was strong outperformance, on a total portfolio basis, was in the ESG pool. This is a smaller, newer pool, and we talked about it several times here on these calls. The ESG long-term growth pool has, whereas the other portfolios are neutral to a slight bias to value and quality, in our construction of our ESG pool, it tends to have a bit more of a growth bias. And that's in part because there are not as many in our research universe, there are not as many value-oriented managers that carry high ESG ratings. We have just seen that ESG market evolve in such a way that the managers just tend to, on average, have a bit more of a growth bias. And that's been part of the challenge for the fund since its inception, but definitely was a tremendous tailwind in a quarter. And you can see over the last year, while it's just a hair behind, it's behind its benchmark. It is just a hair behind its benchmark. So we still like the construction there. We continue to look for managers to try and balance some of that style exposure out. But all the managers underlying are all quality managers in our view. And most of the managers, not everything works at the same time ever, and that's by design. Most of the managers, though, are well within expectations for their specific underlying benchmarks. We feel like we have a good manager set here. And the market kind of sort of came back to this solution or this strategy here in the fourth quarter. Over the 1 year period, diversified long-term growth modestly ahead of benchmark. The other two actives, or the active long-term growth, a bit behind. Both active strategies competitive with the passive long-term growth approach. We want to be, there or better over time by taking active risk. And so, we're there or better with those other two long-term pools. And as I talked about the ESG pool, getting some wind to its sails with a modest amount, outperforming a similar risk profile in the passive long-term growth, and just behind its own specific benchmark. So we're not satisfied when we underperform. It is easier to take when it's underperformance when we would expect to get it, but our objective remains above all else to deliver to you the absolute returns that you're after in meeting your long-term giving needs to the Charlotte community, as well as delivering excess returns for the fees that you pay. So with that, I will pause or stop my formal remarks, and I'll pass it to Natalie with any questions we may have.
Great. Thanks, Travis. So please put your questions in the Q&A box. The Q&A button is at the bottom of your screen. Click that and you can type in any questions you may have, and myself, Travis or Tim will take it. I'll wait just a moment. And one question for you coming in, Travis. You touched on ESG and how it had a notable outperformance versus the benchmark and why, but can you just tell us a little bit more about the strategy and how it's constructed and highlights of underlying managers and why it may be a good option for donors at this time?
Sure. Yeah, absolutely. So starting, I guess, from the top down, we wanted to create a long-term pool. So each of the long-term pools in your current lineup today, or your options available to you, they're all built under the notion of 75% of the assets to longer-term growth-oriented investments and 25% of the assets in fixed income or other risk-reducing assets. And so the ESG pool is built in the same fashion, 75% to public equity and 25% to public bonds. Within the manager selection structure, our manager researchers, when they rate a manager based on and create an expectation through a rating as to the potential for a manager to outperform going forward, at the same time, they rate the degree with which ESG factors are integrated into the manager's investment strategy. Those managers that are, if you will, focused entirely on ESG will be an ESG 1, and those managers that have really not done anything to integrate ESG would be an ESG 4. And those are our 4 scales, 1 through 4 are our ratings. We set out to find highly rated managers from our research team, so A and B plus managers, the managers we think most likely to outperform going forward. And we also looked amongst that group for the subset of managers that were ESG 1 or ESG 2 rated. And so really trying to focus on managers that have a high degree of ESG integration into their strategies. And these are not necessarily strategies that are, fossil fuel free or focused on any one social dynamic, but rather each of the managers integrates ESG in a slightly different way into their overall portfolio mix. There are only 1 or 2 managers in the lineup that are actually recognized as, quote unquote, ESG managers. The rest of the managers just find that the additional components of ESG characteristics are valuable to their investment strategy. And they believe that those notions, things like paying attention to environmental damage or attention to diversity and equality in hiring and management practices, are going to be valuable to their long-term business prospects. And as a result, they've integrated those into their selection set. And then we take amongst those to fill out, if you will, the 75-25 allocation. So Morova Global Equity is an example of a manager that is much more explicitly focused on ESG, whereas Causeway International is a value strategy that is, if you will, a more mainstream strategy, but an ESG 2 strategy because they have integrated a great deal of ESG in their portfolio. And then the last notion that went into the construction was to seek to provide the most amount of diversity and inclusion we could at the manager level with the portfolio. So Causeway is a good example. One of the 2 founders is a woman. She owns a third of the company. She's a lead portfolio manager. So it's those kinds of contexts. One of Payden and Regal's low duration strategy, which is also in the fund. Similar concept. Joan Payden founded the firm about 40 years ago. It still tends to be, the portfolio is still primarily managed by a female group. It's still primarily owned by women overall. So there was a desire from the foundation to build in that extra layer of overlay. And so we did that to the best of our ability as well.
Great. So I have 3 more questions
Okay.
from the audience, but they're around the same thing. So you could probably guess what that is in regard to recent events. So the regional banking situation and sector. So really 3 questions. I'll try to just summarize all this in one. But first, what's the exposure among the pools? And then just what is your thoughts or Mercer's thoughts on the impact to the economy in the short term and over the next year? And has it impacted Mercer's investment perspective as well as anything we're doing in the pools?
So we have on the original 3 banks that were taken over. We did de minimis exposure. We had a small amount of exposure here or there. Regional banks are a meaningful allocation within the small and mid cap indices. So, I don't have the exact number off the top of my head. I probably should, but I don't. So apologies for that. We're going to have some modest exposure to regional banks. It hasn't really changed our outlook. I think there are some potential risks into regional banks that we're likely to see. In many regional banks, much of what they do is commercial real estate lending. And commercial real estate, particularly things like office, have come under a fair amount of pressure, both with the change in, the I don't know, reverberation maybe is the right word, from the end of the pandemic. Offices are still not full. I'm in Washington, D.C. today. The streets are full, the sidewalks are full, but even in our office, it's, not everybody comes in every day. And that has some impacts and will have continuing impacts on the office environment. So we could see some of those reverberations with regional banks that do a lot of real estate lending as we move through the year. I think that's something to keep in mind. We don't see it at this point as sort of that lurking monster around the corner that's going to throw the world out of whack. But banking is an important part of our overall financial system, so it does bear watching. I have not heard, and Tim, I don't know if you have either, of managers that are just exiting the space. Clearly, there's been a lot of capital to leave regional banks. The KRE, I think, is the ETF for regional banks, and it is down quite a bit. And there are a couple of other banks whose current stock prices suggest participants are concerned. But it does not feel like it's hit critical velocity yet in terms of the potential to I don't know. I want to be careful with my words here because I don't want to underpromise and then overdeliver later, or vice versa. But it's a risk that we're monitoring, but we have not necessarily changed our outlook at this time. But it's certainly a risk that will continue to bear watching as it develops going further. Tim, I don't know if you'd add anything there.
No, the only thing I'll add is, I haven't heard equity managers pulling out, but that's been a frequent topic among private equity managers, is that they're shifting operations and capital calls and wires and things like that to kind of the bigger players in the space. So that will also, even though it's not deposits, it's going to have a knock-on effect on their operations and kind of consolidate everything across the industry.
So good question, and more to come from us as we go as that further develops.
Great. No, thanks for that. Let me see if there's any other questions who've come in. One question for you. You mentioned the small number of individual stocks that were really driving outsized U.S. equity performance in Q1. Is the U.S. equity building block allocated appropriately to take advantage of their market leadership? And if not, what is our view for the rest of the year?
So good question. So we're current portfolio construction with the building blocks, the U.S. equity building block is about 75% to S&P 500. So we're passive in U.S. large cap. That gives us a lot of exposure to those names because they are at the top of the index. Part of the reason why they create such drive is they're big companies. And when they perform well, particularly as they did this quarter, I think Tim gave you the stat, Tesla lost like 65% of its value last year, and then it was up or 68% in the first quarter. So those kinds of large market cap companies really drive the top of the index. And it's part of the reason why we're passive in U.S. large cap, because it's very difficult to maneuver those waters in an active format. So we have good exposure there. The other 25% of the portfolio is split 15% to small mid, which is about the U.S. market cap weight. That's about the U.S. market cap weight. So about 15% of the portfolio is in small and mid cap stocks. And then the other 10% is in low volatility equity. So strategy focused on higher quality companies and stocks that just exhibit relatively less volatility versus the broader benchmarks. The notion being that low volatility strategy compounds more sanely over time, if you will. It basically saws off the tops and bottoms of market movements. So when the market goes really strongly but narrow in a quarter like the first quarter, that component of the portfolio did underperform and contribute to the underperformance. But it was also a really strong positive contributor, relatively positive contributor in 2022 when the rest of the market was down a lot. So we like that as a stabilizer, and it helps the equity portfolio compound more, again, sanely over time. So what's the risk to that structure today? If the first quarter is not a blip and it's going to be the way the market's going to go for a couple of quarters, we're not going to participate fully in that because we have diversification. And it's difficult for most active strategies to outperform when you're in that environment, because if you're, I don't know what Apple at one point was 10% of the S&P, I think, or 8% of the S&P. So to take a bet on Apple, you have to own more than 10% in Apple. That's just a really hard environment to outperform in when those names drive the index. So again, it's a period we don't necessarily want to chase that, but we are, we're considering always portfolio structure, and is the market telling us something that we should be repositioning for? Nothing today, but those are conversations. I had just such a conversation with our portfolio management team yesterday. We continue to have those conversations about, are we positioned right? What might we do in the construct of our portfolio if we felt we wanted more exposure to those types of names? We would probably just trim our small mid cap and or our low volatility allocations down from target. We have in the past, we have been modestly overweight our small mid allocations within the US equity when we felt that was more attractive. And when we felt that went away, we pulled that back down to neutral. So those are some dials that we can turn. But today we're sitting right about our long-term targets.
Okay. Great. Well, I don't have any other questions from the audience. So I want to thank you, Travis and Tim, and David Hestorfer as well from Mercer, to be with us today and sharing your insights in the market's performance. Thank you to our participants. We hope you found the webinar informational. Reminder that we will be posting this recording on my FFTC/resources as soon as possible. So thanks. Have a great rest of the week.
Thanks, everyone.
Thanks a lot.